Hi, and welcome to Chapter 8. Today we're going to talk about implementing strategies focusing on finance and accounting issues. So our learning objectives are going to be to determine what's the most appropriate capital structure for the company, how to measure performance using earnings per share, and EBIT, which is earnings before interest and tax, to compare relative attractiveness between debt and stock, and look at strategies of sourcing capital, look at projecting financial statements, the impact of recommendations and associated costs, determine the cash value of a firm, and discuss the financial ratios and things like initial public offerings, issuing bonds, and strategic decisions related to accounting and finance. Okay, so this fits in here in Chapter 8. So we've gone through the introduction and discussion of vision and mission statements. We talked about internal and external factors, strategies and action, strategy analysis and choice, implementing strategic strategies using management and marketing themes and techniques, and now we're finally into finance and accounting. Okay, so first of all, what is capital structure? Capital structure is the sources of funding a company chooses to raise capital. In finance and in business, capital is just another fancy word for money. So a company needs to determine their capital structure, and they need to find a capital structure that's going to have the lowest weighted average cost. And the cost of the capital structure is the interest you pay on bonds, dividends you might pay on stock, interest on bank loans, things of that nature. Now, most strategies that companies develop are going to require additional capital. This means they're going to need money to expand, to make an acquisition, to buy equipment and machinery, to do corporate training, to hire more employees. They're going to need sources of money to fund these new strategies. So there should develop a fully fleshed out pro forma financial statements, which are also called projected financial statements, to show the impact that these strategic recommendations will have on the finances of the company. And then the company would need to perform a corporate valuation to see whether or not the financial situations they're getting into is going to be valuable to the corporation. So whether it's receiving an offer to be purchased, or if it's buying another division or another small company or merging with two companies, we have to perform this corporate valuation to see if there truly is value in the strategic direction of the company. Okay, so analyzing financial ratios is a big part of analyzing a company's performance. So financial ratios come in usually 5 categories that measure financial and management performance of a company. We'll talk more on this later. Now, the initial public offering is when a company decides to sell a piece of itself to new shareholders. So new shareholders buy the stock and they get a percentage of ownership in the company, and this helps to bring new cash into the company. Now, cash levels of the company are also affected by its retained earnings, the amount of money the company makes by doing its operations, and after taxes and interest they can reinvest in the company. And of course, corporate bonds, the amount of money that companies could raise by issuing debt in the form of corporate bonds to be paid back in usually a 30-year term at a going interest rate. Now, capital structure, we're looking at what's the percentage difference between the portion of debt to the portion of equity. We call this debt to equity. So on the balance sheet, this can be referred to as a capital structure. How much of the firm's equity is financed by stock and how much is financed by bonds? So what is a firm's equity? So if you take all the assets, you minus all the liabilities, and you get equity. So the equity needs to be, those assets need to be financed by either debt or equity. And equity can come in the form of issuing stock, retained earnings, as the 2 biggest sources. So if we're performing a earnings per share or EBIT analysis, this is a common way to determine what the appropriate capital structure of the company is needed. So if a company has a lot of earnings, it might be more appropriate to borrow in debt because it has the money to pay the dividends. If the company is low on cash, it might be more amenable to issue stock to help raise new funds. Now, let's talk about some accounting terms. EPS, this is earnings per share, which is simply the net income divided by the number of outstanding shares. This is a very important ratio because it looks at for each share of stock that's outstanding. So if you're an investor that owns one share of stock, and you say that share is $25 is the current market price of that share, and the earnings per share are $5 per share, that's how much of the earnings can be contributed to one share of stock. And the higher the earnings per share, the more valuable that per share of stock is. And typically, as earnings per share increases, so does the stock price increase. EBIT is earnings before interest and tax, sometimes called operating income. So this is the money that the business makes. And it's very important that, some companies can look profitable, but you want to look at the underlying business. Is it generating the profits? Outstanding shares is the amount of shares that are issued and are out to the public. Now, the shares issued include treasury stock. So treasury stock is shares that the company has purchased back, and it goes into treasury stock under the equity section. So outstanding shares are the shares available to trade, and shares issued are all the shares available to trade plus treasury stock. So shares authorized is the number of shares a firm is approved to issue in total. So a company might be approved to issue 100 million shares of stock, but they may choose to only issue 50 million shares at this time, and they can do a follow-on issuance of stock at a later time. EBT is earnings before tax. EAT is earnings after tax. So these are just common accounting terms you should be aware of. Now, the earnings per share to EBIT analysis. So we're looking at whether or not, so we have EBIT, which is operating income. Earnings per share is going to take the operating income and subtract the taxes, subtract the interest, and then we get our earnings per share. So what the difference between the two will denote how much debt is used. So it's a combination of the two best alternatives for raising capital and implementing strategy. So it's either debt or equity. So when we look at the difference or look at the percentage of earnings per share to EBIT, it gives us the impact the debt has versus the stock financing because it gives us a ratio. And this analysis is going to give a four-step process. So let's look at the inputs needed. So we have P&G, which is a pretty big company, and we have the amount of capital needed. They need $5,000 million, or we'll just say 5 million. I think that's how it should read. Our earnings before interest and tax range is going to be anywhere from 10 to 18 million. Interest rate's 5%, tax rate's 23%. Stock price is $94, and outstanding shares is 2,550 million. Okay, so now let's calculate the earnings per share in EBIT analysis. Everything's in millions here except the earnings per share row. So here's our and we're looking at, we're doing the common stock forecasting and the debt financing, common stock financing, debt financing in three scenarios: pessimistic, realistic, and optimistic. So we have our operating income, the interest, earnings before tax, taxes, earnings after tax, number of shares, and earnings per share in these various scenarios. So if we look at the, if we're doing 60% stock and 40% debt, this is how that would overlay as far as, if it's 60% stock, 40% debt, this is how we kind of project pessimistic, optimistic, and realistic. So between 10 and 18 million. And then how that's going to translate into different earnings per share. Of course, optimistic will have the highest earnings per share compared to pessimistic. Now we can see if we're looking at the cash flow, the common stock financing. So that is this green line here, the common stock financing. So we can see that if we finance with stock, here is the change in overall earnings per share. Now, that when we finance with stock, earnings per share is muted because we're issuing new shares of stock. So we don't see as big of a change in earnings per share because the new shares of stock we're issuing is diluting the profits from the new project. Okay, debt financing. If you look at debt financing in the purple, this is going to have the biggest kick up in earnings per share because we're issuing no new shares. So we get, although we do have to pay interest, but we're getting to keep all the profits and it's going all to the current shareholders. So you see the biggest change in earnings per share when you do debt financing. And a combination of equity and debt financing, we see a sort of the middle ground between the two. So you would probably say, well, why a firm should always use debt financing because it returns the most amount of earnings to investors. That's true. However, the more debt financing you take on, the more costly it becomes. Interest rates go up, risks go up. So it gets to the point where debt financing no longer is a significant contributor to earnings per share. And that's why most firms do a mix of debt to stock when they're doing their capital structure, especially if they're looking to borrow a lot of money over a long period of time. So let's just go back for a minute. Let me just go back here. Okay, so, this 4-step process. Step 1, just because I don't think I made this clear before, step 1 is gathering the data that you need. Step 2 is setting up a computational table similar to this, where we have all common stock financing, all debt financing, or a combination of debt and stock financing. Step 3 would be inputting the numbers into these tables, and then step 4 would be graphing the results. So those are the 4 steps to doing that process. Now, let's talk about those limitations and considerations. One is flexibility. So a firm's capital structure, the way it's designed is going to affect the flexibility as far as future capital needs. So if you issue all your stock, you can't issue new stock in the future unless you go through a lot of paperwork to get an increased amount of shares to be allowed to issue. If you issue all debt, you may have a very high interest rate and it may limit your borrowing and debt in the future. So using all debt or all stock is going to, create these obligations. And sometimes these obligations might include restrictive covenants, which means that bonds can start saying what your business can and can't do. So the flexibility can be the issue. Dilution of ownership. If you issue too many shares of stock, you're diluting the ownership of the current investors and you're diluting the earnings per share. The timing. So interest rates change. Sometimes there's inflation. Sometimes interest rates go up very high. Sometimes they're not attractive. So the timing as to when you want to issue stock or bonds is a big deal. So sometimes the stock market has years where there's a huge amount of IPOs coming out, and sometimes they have years like 2022 where very few IPOs are coming out because stocks are going down and stock prices are not appreciating and people are just sort of not putting a lot of money in the stock market. But a year like 2022 is particularly challenging because interest rates are going up, so it's making bond borrowing more expensive, and stocks are going down, which is making issuing new shares of stock less attractive. So this is one of the things that's done by design by the Fed, trying to hope that they'll slow the economy. So timing can be a big issue. Leverage situation. So firms that are highly leveraged, this is going to show up if you borrow a lot of debt. This is going to show up in your ratios, in your leverage ratios. And this is going to make your company appear more risky, which could make the required rate of return on your stock higher. Continuity. So as far as, the analysis is assuming a certain stock price, a certain tax rate, certain interest rates, in all 3 scenarios, pessimistic, optimistic, and realistic. But those scenarios, when they occur, is going to have a different effect on stock prices and debt and interest. So, one of the limitations is kind of looking at everything the same way, which is not reality. Operating income ranges, estimates based on prior year, but businesses change for other reasons other than, it could just be consumer demand, competitors. So there's a lot more into that affects operating income than just trying to predict it from one year to the next. And of course, dividends. If earnings per share values go up and the firm pays dividends, then it's going to have less funds if it's committed to paying dividends, because that comes out of the firm's cash. Okay. Projected financial statements. Now, projecting financial statements is something that companies have to do. And oftentimes we call these pro forma financial statements. And what we're trying to do here is figure out what the future is going to look like, based if we make certain strategic decisions and we expect certain expenses to occur, and we expect certain growth of revenues. We want to project the financial statements to allow us to have better control over where our financial ratios are going and better understanding of how our financial results will be next year. Okay, so let's look at some of the steps in developing projected financial statements. Okay, so one, we're going to prepare the projected income statement before the balance sheet. So the income statement comes first. So we start by forecasting the revenues as accurately as possible. So if our recommendations are to open up 100 new stores and this is going to increase revenues by 10%, that's where we start. So we'd increase the revenues by 10%. So we could do that in three different scenarios. So maybe the pessimistic is 10%, the most likely is 15%, and the most optimistic is a 20% increase in sales. So it all starts with projecting our sales. And so this revenue growth is going to be a factor of the strategic decisions we're going to make. So this is the result that we are expecting our strategy to result in an increase in sales. And sometimes some strategies can result in a decrease in sales if there's a retrenchment or a closing of stores or a reduction of operations. So that's just things we want to keep in mind. Two, we're going to use a percentage of sales method to calculate cost of goods sold, operating expenses, and other variables on the income statement. So the percentage of sales method is basically saying that if sales go up 10%, then our cost of goods should go up 10%, which means our gross profit should go up 10%. So we're just linking the sales growth to a growth percentage for many of the variables on the income statement. Step three, we're going to calculate the projected income statement. And in step four, we're going to subtract any net income we're going to extract dividends from the income that need to be paid for the year or we've already committed to paying. Step five is, now just let's take a step back. Let me just go back for a second. When a company has net income, there are two things they can do with the net income. They can either keep it as retained earnings, which means they can keep the money and invest it back in the business, or they can pay dividends. So retained earnings will go over to the balance sheet, and we're going to add this to, it's sort of a roll forward of the money that the company has made and is kept. So retained earnings is a source of equity that we're going to store on the balance sheet, and it's going to be used to complete our equity section, and that money can be used to buy assets and run the company. So, think of this, if the company makes net income, there's two things they can do. They can either pay dividends or keep the money, and if they keep the money, it's called retained earnings. Okay. So that's just something to think about. Okay, so step five, we want to project the balance sheet items working from the bottom to the top. We begin with the retained earnings. So if the net income is produced some retained earnings, we want to calculate that and we want to add that into the equity section. And then we're going to move it up to the forecasting of long-term liabilities and current liabilities, assets, and so forth. And again, a lot of this information is if we're not retaining earnings, the additional money that we're going to need to fund the company is going to have to come through debt or long-term debt. So we can use the cash account as sort of our plug figure, which means that we're going to project every line item on the balance sheet except cash. And we're going to use the cash account to make the assets equal to the sum of the liabilities and shareholders' equity. So to make the adjustment, for example, the cash needs to be changed so that the balance sheet will balance. And this is just, it's not a forecast of where cash is going to be. It's basically going to be just something to help, show the difference between the assets, liabilities, and the equity. So for example, if the cash is too high, we might want to consider paying off some long-term debt. We could reevaluate the projected increase in various liabilities because of the possibility the firm may have enough cash to cover them or cover the increases in the business. We may want to buy stock back if we have a lot of excess cash and create some treasury stock. So the cash account is very important here. And 7, we'd list any remarks that we have about the projected income statements, to clarify the risks, to clarify the changes we made or the decisions we made as far as increasing our revenues or how our strategic decisions are going to impact our financial statements for next year, specifically, but not limited to, any increase in potential taxes by increasing our overall revenues and profits. Okay, so let's talk corporate valuation. So a corporate valuation is basically trying to figure out how much a company is worth. Now, a company that has stock issued, it's kind of simple because whatever the outstanding shares are times the current stock price, we would get the valuation of the company. But a number of companies are not publicly traded, so we don't have the stock to help us. So the corporate valuation is, I guess, it's an estimate of the value of the firm, and the value of the firm, how the firm is valued is up to how the financial analyst wants to value the firm, because there's many different techniques. So, but all these techniques are going to rely on the financial facts of the company and hopefully good experience or good judgment of how the company has performed in the past. So the different valuation methods, of course, usually always result into different values. So the company has to use what they feel would be most accurate for their particular company. So a couple of different methods you could use. You have the net worth method, which is the shareholders' equity minus any goodwill or intangible assets. You have the income method, which is just income times 5. You have the price to earnings ratio method, where we take the stock price divided by the earnings per share and then times the net income. You have the outstanding shares method, which is the number of outstanding shares times the stock price. It's kind of the method I had mentioned before. So let's just talk about each of these methods in a little bit more detail. The net worth method, of course, if we're looking at shareholders' equity from the balance sheet, we want to minus out goodwill and intangibles. So let's see, what is shareholders' equity? We can think of this as owner's equity or total equity or net worth. Those are just different names for the same thing. And it's always near the bottom of the balance sheet. It represents the sum of common stock, additional paid-in capital, retained earnings, and treasury stock. So after calculating the shareholders' equity, we want to subtract goodwill and intangibles. So these items appear in a firm's balance sheet where intangibles include copyrights, patents, and trademarks, things that don't have a physical aspect to them. And goodwill is from when a company acquires another company and pays more than the book value of that firm. And that will be put into a goodwill section. So that's why we want to minus these two out, because they're really not easy to value, or that can easily be manipulated in a way that it's better to leave them off of the net worth method. And sometimes these intangibles can result in a negative valuation. So how can a company be worth negative? They usually just distort. That's why we want to take them away from the net worth method. So net income method is another approach you can use, and it's measuring the monetary value of the company that grows out of the belief that the worth of any business should be largely based on the firm's future benefits, that it's going to create money and create profits. So the rule of thumb is established that the business's worth is 5 times the firm's current annual profit. Sometimes this could be amended to be instead of the net income method, the cash flow method. It can be 5 times the business's cash flow, since cash flow is a little bit more pure of the money that the company generates, because then income is distorted by taxes. Okay, the price to earnings ratio model. So this is going to use the PE ratio, and it's going to divide the stock price by the firm's annual earnings per share, and then we're going to multiply this by the firm's net average income for the past 5 years. And this is going to give us a valuation of the company. Now, valuation method number 4 is the outstanding shares method, which is the number of shares times the stock price. So it's just quite simply the market capitalization, something I had mentioned before, because the stock market's already valuing the firm. So we could just use the value that the stock market places on the firm. Now here's an example of the inputs that commonly be used for these valuation methods. And then if we look at the results, we see the results of the 4 methods. So each of them have very greatly varying results as far as how the valuation model is resulting in the valuation of the company. The method average is 135 million, but you can see that some of these might be overvaluing the company, some of these might be undervaluing the company. So you can see that this is why a company really needs to pick a valuation method that is the best representation they feel the company is valued at, because some of these methods just won't work for some companies. This will be distorted amount of valuation. So let's talk about the financial ratio analysis that I had mentioned earlier. So this is how, think of financial ratios like a report card. So, so you have your grades, and your grades give you a GPA, and the GPA is like a quick ratio of how you're overall doing that semester, or overall that year, or overall your whole degree. So these are ratios that look at financial statement categories and put them in a ratio that's more comparable between years and between companies. So you can compare, once a company creates a set of ratios from the income statements, they can compare their company to the industry, and they can compare themselves to key competitors, because the ratios are comparable, where just the full numbers from the income statements are not easily comparable, because companies come in different sizes of the business. Now, just to back up on this slide a little bit on the financial ratios. So there's a number of financial ratios that we can talk about. Typically, a company is going to have to look at liquidity ratios like current ratio and quick ratio, total debt to asset ratio, total debt to equity ratio, times interest earned ratio. So these are all looking at debt and liquidity of the company, looking at the current assets to current liabilities, total debt to assets, total debt to equity, the amount of interest that the company is paying in relationship to its earnings. So these are all looking at the liquidity or the debt of the company and seeing how risky a company is on these ratios. Now, keep in mind that these financial ratios, we're not going to cover them extensively here, because they've been covered in financial accounting and finance, and maybe many other courses kind of give you a full list of financial ratios. But they also include some operation ratios. We're looking at fixed asset turnover, inventory turnover, total asset turnover, accounts receivable turnover, average collection period. So these would be activity ratios or management ratios, looking at the actual change in the business, the change in the inventory, the change in the assets related to the sales, how quickly accounts receivable is being collected, how quickly accounts payable is being paid. Then finally, we'll have more of a set of profitability ratios. We'll have a gross profit margin, an operating profit margin, return on assets, return on equity. So these really are looking at comparing and analyzing the profits of the company through various stages. The initial growth stage, which is just the products minus the costs, to the operation stages, which is the gross profits minus the operating costs, to the net income or net profit, which is the taxes and interests. And finally, you might have some ratios in the market measures as far as earnings per share, book to equity, book value per share, book to price. These are just different types of ratios. So there's a lot of financial ratios that companies can utilize to compare themselves to previous years, compare this year's results to this quarter's results to previous years or quarter's results, and to also compare against competitors in the industry. Okay, moving on to IPO and corporate bonds. So if a company is doing well and it's starting out, and say you take a company like Shake Shack, which originally started with a handful of stores in New York City. They started doing well, they started expanding, and they got to a point where they needed a lot more money to continue the expansion of their corporate-owned stores. So they're not franchise, they're financing these stores exclusively themselves. So they chose to do an IPO, which means they're going to issue Shake Shack stock, and the stock's going to be issued to the public, and it's going to raise millions of dollars for them to reinvest in the company. So it's a good way of a company to raise capital. Now also, we might have an issue where we can't raise any more stock equity. It's just not worth it to dilute the current shareholders, or there's just no appetite for it or in the marketplace, so we might decide to issue bonds instead. So raising money through issuing bonds is basically issuing a bond for 30 years and $1,000 per bond, and we promise to pay a dividend on these bonds, and then when the bonds come due, we pay the principal back to the investors. Now, generally, an investment bank is utilized to help a company go public or help a company issue corporate bonds, because both these processes are very labor intensive and takes a lot of regulations and a lot of accounting and a lot of legal purposes. So oftentimes, 99 out of 100 times, a corporation is going to go to an investment bank to help to get this work done. But those are the two main funding sources for large companies. Smaller companies may raise some funds by taking a bank loan, by having the owners of the company take personal loans, doing some fundraising, going to equity investors. That would be sort of people who want to invest in the company early on before it goes public, to raise some capital, investors, things like that, to raise some money. And typically a company has an evolution where they start out small, and as they get bigger and bigger, they go for bigger sources of capital to keep growing the company. Okay, our last slide here, we're going to look at how to gain. This is a common slide that appears at the end of most chapters, and this is how to gain and sustain competitive advantage. So basically, as we had said, you need a clear vision and mission statement that helps you to formulate strategies, collect and analyze data, and make clear strategic plan. Then we implement that strategic plan as far as getting it done and getting to what we need. And then part of the evaluation and monitoring of results is a lot of this finance and accounting, where we're looking at tracking the results of the spending, the earnings, the profits, and then taking that into consideration to clarify our mission or our strategic formulation. So this is sort of this continuous circle of work a company does to continually gain and sustain their competitive advantage over other companies. Okay, so that's chapter 8, implementing finance and accounting issues in strategic management. I look forward to talking to you for chapter 9. Take care.